Let me ask you something. The Dow Jones just crossed 51,000 for the first time in history. The S&P 500 just completed its longest winning streak in 3 years. The headlines are celebrating. Your financial advisor is sending you emails telling you everything is great. And yet, somehow, you still feel broke. Your rent went up, your groceries cost more, your paycheck feels smaller every month, but the stock market is at all-time highs. So what exactly is going on? I am James Caldwell, and today I am going to tell you everything the financial media is deliberately leaving out of that celebration. Here is the first thing nobody is telling you. When they say the stock market hit an all-time high, they are not talking about your money. The S&P 500 is a collection of 500 of the largest companies in America. Apple, Microsoft, Nvidia, Amazon, and here is the reality. The top 10 companies in that index make up nearly 35% of its entire value. That means when the market goes up, the people who benefit the most are the people who already own the most. The top 10% of Americans own 93% of all stocks. Read that again, 93%. So when the Dow hits 51,000 and everybody celebrates, what they are actually celebrating is that the wealthiest 10% of Americans just got significantly wealthier. Again, now I am not saying the stock market going up is bad. I own stocks. You should own stocks. But there is a massive difference between understanding what is actually happening and being told a feel-good story designed to keep you passive and compliant. And right now, the story you are being told is incomplete, deliberately incomplete. Here is what is actually driving this rally: artificial intelligence, specifically Nvidia. Nvidia has become one of the most valuable companies on the planet in an extraordinarily short period of time. And because it sits inside the S&P 500 and the Nasdaq, every time Nvidia goes up, the entire index goes up with it. So when your 401k shows you a nice green number this month, a significant portion of that gain came from one company making chips for AI data centers. That is not a diversified economy doing well. That is one sector, one technology, pulling the entire market higher. And history has a very clear lesson about what happens when one sector pulls everything higher. In 1999, it was internet companies. Every tech stock was going to the moon. The Nasdaq gained over 80% in a single year. Everyone was a genius investor. Everyone was getting rich on paper. Then March 2000 happened, and the Nasdaq lost 78% of its value over the next 2 years. Trillions of dollars of wealth gone. I am not predicting a crash. Nobody can predict a crash with certainty, but I am telling you that a market being driven by one sector, one narrative, one technology, has happened before, and every single time it has happened, the people who got hurt the most were the regular Americans who got excited at the top, not the hedge funds, not the institutional investors. They get out first. They always get out first. The people who lose are the ones who saw the green numbers, felt the excitement, put their savings in at the peak, and then watched it all disappear. Here is the second thing nobody is telling you. The Iran conflict is quietly doing something to this economy that almost nobody is talking about. Oil exports through the Strait of Hormuz, one of the most critical shipping lanes on the planet, are disrupted right now. And disrupted oil supply means energy prices stay elevated. And elevated energy prices are inflationary, which means the Federal Reserve, which has been trying to cut interest rates to give Americans relief on their mortgages and credit cards, is now stuck. They cannot cut rates aggressively if inflation is being pushed higher by a geopolitical conflict they have no control over. So while the stock market is celebrating record highs, the average American is sitting with a mortgage rate above 6%, credit card interest rates near 20%, and an inflation problem that is not going away as fast as anyone hoped. The market going up and your life getting easier are two completely different things, and right now they are moving in opposite directions. Here is the third thing nobody is telling you. Berkshire Hathaway is the company run by the most successful long-term investor in American history, is currently trailing the S&P 500 by its biggest margin this year. Now, why does that matter to you? Because Berkshire Hathaway does not chase momentum. It does not buy overpriced technology stocks at record valuations. It buys value, real businesses, real cash flow, real earnings. And when a disciplined value-focused fund significantly underperforms a momentum-driven market, it historically means the market is running on excitement rather than fundamentals. The last two times Berkshire significantly underperformed the broader market, 1999 and 2007. What followed was one of the worst market downturns in modern history. Again, I am not predicting a crash. I am telling you to pay attention to what the smart money is quietly doing while the headlines celebrate. So what should you actually do with this information? Number one is do not panic sell. Panic selling is almost always wrong. If you are in a diversified index fund for the long term, stay in it. Time in the market beats timing the market. That is still true. Number two, do not add new money at the top out of fear of missing out. The worst financial decisions in history were made by people who saw everyone getting rich and jumped in at record highs because they did not want to miss the party. Number three, make sure you actually understand what you own. If your entire retirement is sitting in a fund that is 35% concentrated in 10 technology companies, you are taking more risk than you probably realize. Number four, build cash reserves, not because a crash is coming, but because cash gives you options. If the market does pull back 20 or 30%, and it will at some point, it always does, the people with cash reserves are the ones who get to buy at the bottom instead of selling at the bottom. And number five, stop measuring your financial health by what the Dow Jones is doing. Your financial health is measured by your monthly cash flow, your debt levels, your savings rate. Your emergency fund, not a number on a screen that represents the stock portfolios of the wealthiest people in America. The stock market hitting all-time highs is not bad news, but it is not the complete picture either. The complete picture is this: a market driven by AI momentum, disrupted by geopolitical conflict, running at valuations that make the most disciplined investors in the world uncomfortable, deserves your attention, not your blind enthusiasm. Stay informed. Stay disciplined, and remember the financial media's job is to keep you watching, not to keep you wealthy. I am James Caldwell. I will see you in the next one. Subscribe for more such quality content videos, because quality is what makes you better than others.